Couldn't tell you. Hey, everybody. It is Helmer here with your weekly mortgage rate update, your market update. Joining me this week is Nathan Einkorn. Nathan, please take a minute and tell everybody a little bit about yourself.
Yeah, Nathan, I got him VVA 4. Been embedded VA since the beginning. Chris may be able to correct me on that, maybe a couple months after. And I am a mortgage broker.
All right. So, everybody, thank you for joining us. It is the last day of January here, January 31st, 2024. And we've got some exciting stuff to talk about as far as if you get excited about mortgage rates. I do. I do. I know that sounds lame, but this is my world and what I get excited about. So if you are here and you are here live, please let us know. Say hello in the comments. If you have any questions or anything to say, please feel free to go ahead and voice them here. We are here to answer your questions and help y'all to kind of know what's going on with your mortgage and what to expect and through everything through that process. If you are watching on the replay, as I know many do us a favor and just say hi in the comments. Give us maybe a hashtag replay. And if you have any questions, we do monitor this post. Feel free to tag Nathan Einkorn, and he is one of the moderators here at Vetted VA, or you can tag Helmer, and I will help you as well. So with that part all out of the way, let's get into the good stuff. Let's talk a little bit about rates, give you a quick recap on where we've been and where things are headed. So remember, when we talk about rates, it's not an offer to lend. We're basically talking in averages and generalities, and you always want to make sure that you do shop around and make sure you're comfortable with who you're working with. So as far as rates, they moved a little bit better, just a little tiny bit better over the last week. They've been really stable the last few weeks. We saw some of our best rates in December, and then they kind of got up a little bit. They went up a little bit in January. But generally, if you are getting a VA rate quote in the low to mid sixes, that should be on the money. If you're getting a rate quote in that realm, that means that things are on the up and up. If you're getting quotes much, much higher or even much, much lower, you want to question and find out why and ask some questions about that. If you're not getting a VA mortgage for any reason and you're going with what we call conventional financing, you'll find those rates are generally going to be a little bit higher. They may be in the higher sixes if you've got really good credit, depending on how much money you're putting down. But generally, you're going to find that in the low to mid sevens. At least that's what I find kind of a national average. Nathan, you're in that Colorado market. What are you finding in Colorado?
Yeah, I'd say you're spot on. I think this morning I actually priced out a conventional loan, and this is just, talking par rate, good credit, 740 plus, putting 20% down. The par was right at 7%. Obviously, you want to watch box A. If you're paying any discount points, buying down the rate, you can get that down into the sixes. And like you said, with VA, that's pretty accurate. We're in the low sixes, and with less than a point buy down, you can get into the fives.
Now you're talking about buy down. Let's take a minute and we'll talk about the forecast and where rates are going to go next in a moment. But let's talk a little bit about what does that mean, par rate? What does that mean with a buy down? Let's start there with that question.
Yeah, so it's definitely mortgage speak. When we talk about par, it's it's kind of like golf, right? Your par is typically going to be the lowest rate that a lender can offer without you paying any points, right? Points are a percentage of the loan amount, and we call them discount points because by paying those points, you can discount your rate. So when we talk about, when we talk about, hey, what's the rate today? It's a question that us in the mortgage industry always laugh about because of all the different factors that go into determining what the rate is, loan type, FICO, down payment, property. I mean, there's a bunch of stuff that goes in there. So, but yeah, so par, like I said, is just going to be that lowest rate you can get without paying any points. And then that's a matter of where, as a mortgage broker, where we become advisors, right? Hey, what should you do? Because oftentimes it does make sense. Personally, I think it makes sense right now in the current interest rate environment to actually take the slightly higher interest rate if you can and get that lender credit to apply it towards your closing costs and save yourself money. Unfortunately, the semantics of it, we see a lot of people marketing within our industry saying like, oh, no cost loans. And it's like, wow, there's no such thing. So be careful about that. But yeah, shop around, make sure you're comfortable with the mortgage broker that you're talking to. But yeah, when we talk about par, we're talking about discount points, that's going to be the base rate that we go off of is par, and then buy downs, buy that rate down.
So, so now for everybody that's watching, let's talk a little bit about why now might be a good time to take a slightly higher rate. So I want you to imagine, I'm going to be repeating what Nathan just said. I'm just going to say it a little bit differently, but it's the same thing. Your interest rate is on a sliding scale. And, that par, as Nathan said, that's like kind of right in the middle. That's the lowest rate before you have to pay to get a better rate. And a lot of times it will get you a small rebate. The lender will give you a small credit towards your closing costs. That's the way mortgages work these days. But what can also happen, you can pay discount points, and a point, as I flashed on the screen before, a point is 1% of the loan amount, but you don't always have to pay a full point. You may pay a half a point or a quarter point. You can pay a fee, and that's going to help you to bring that rate down. But a lender got
real quick, a good distinction to make, because this often comes up. When you pay a point to buy down your rate, you're not buying the rate down a point, right? You're not buying it down from 6% to 5%. Yeah. The point, like Helmer, that's the percentage that you're paying of the loan amount to buy, not the purchase price, the loan amount.
I'll have to put together a nice slide to make this visual for people. But if you pay 1%, you may be bringing your interest rate down 0.25%. So it may cost you on a $400,000 loan. 1 point would be $4,000, and it may bring you from 6 3/4 to 6.5. But in this market, what Nathan said was you may want to take a higher rate. What that means is that you can actually, let's say that same interest rate, instead of 6 3/4, maybe you took 7. And then if that happened, what would happen to the lender? What does the lender do if you take a higher interest rate, Nathan?
They're going to give you what we call a lender credit. And that amount, once again, varies based on loan amount, what rate you take, your credit score, all those types of things. But, for instance, instead of taking 6, you take 6.5. Now that lender is going to actually credit you, possibly just like the buy down points, they're going to credit you a percentage back, right? So if you wanted to get a 1% lender credit, you take that higher rate, and now that lender is basically contributing towards your closing costs. They're giving you credit back, and now that credit cannot exceed the closing costs of the loan. Right? You're not going to it's not going to be applied towards down payment. It's not going to be applied towards anything but actual closing costs.
And that's something that you can talk to your mortgage professional about. But I saw this post as I was hopping into the Vetavia community today, and it said, is it weird to ask for seller to pay closing costs? I feel like we'll never own another home because we don't have the money for closing costs. Our realtor keeps asking us and bringing up how we don't have X amount to do this. And that may be something that may help you, is maybe the lender can help offset some of those closing costs. And there's a lot of intricacies to this. There's a lot of rules y'all may not realize, but when you do anything that's related to the government, there's a lot of red tape and a lot of rules, right? What a surprise. But it is a conversation, and it's something that people may want to consider more right now than in other times, because we are in an environment where we expect rates to fall. So you could get a mortgage rate today of, say, 7 1/4. You could get a chunk of money to help those closing costs. And then in the future, maybe in 8 months or a year, you may see rates that are lower, and they can help you bring your payment down. Again, you should always be able to qualify comfortably for what you're paying today. That's something that, again, you should talk to your mortgage professional about. But I'm not proposing anybody take payments that they don't feel that they can comfortably afford. But at the same point, we're in an environment now where we do expect interest rates to fall. And let me move this off the screen, and let's talk a little bit more. But go ahead, let's talk.
I was going to say, another thing that comes into play is how long you're going to be in the home. So it's not even oftentimes it's not even a matter of, especially with our active duty, right? We know you're going to PCS. You're going to be moving in 2 to 3 years, depending on your contract, right? So there's those factors to take into play. So it's kind of one of those where, I recently had a client, they wanted to buy, they were obsessed with interest rate, right? So they wanted to buy the rate down. But it cost $5,000 to buy the rate to where they wanted it. And the savings was going to be about $125 a month. Right?
So that's $125 a month. That's only 12. So that's
you math that out, and if you're only going to be in the house for 36 months,
it's $1,800. It's not much. Yeah.
So and that's where, like I said, we are advisors. Like, our job is to do the math for you. A lot of people get frustrated in those questions that are in Vetted VA. A lot of times, like, people start off with like, I know this is a dumb question, or I know it's been asked, and I always tell everybody, like, hey man, we talk mortgages every single day. That's why, for us, it's relevant, for the rest of the world, mortgage knowledge is pretty damn useless as you're walking around on a daily basis. So don't feel bad that you don't know these things. That's what we're here for.
Yep. And that's exactly. And that's why we hold these, these weekly sessions for you. So I want to give you guys a quick rate forecast on where things are going and why. So hopefully the worst is behind us. And I repeat this every week right now, because I think that people just really need to kind of understand why. The worst rates that we saw were October of 2023. That was the last time that there were expectations that the Fed was going to go ahead and hike their Fed funds rate. Now, the Fed does not set mortgage rates. However, mortgage rates are heavily influenced by the Fed's activities and the rate that the Fed does manipulate, which is their Fed funds rate, or I'll call it their policy rate. So the Fed only has one lever that they can move back and forth, and it's that Fed funds rate. Now, what's going on right now, we have a Fed meeting today, and in about 2 hours, the Fed will release a policy statement. And at that meeting, they are expected to go ahead and leave interest rates where they are at. So this is what I've got on the screen right now is what we call Fed futures. This is what the markets are betting on. The probabilities will be for the Fed to either hike their policy rate, cut their policy rate, or leave it the same. Now, across the top of this, there's 8 tabs, one for each of the meetings this year. The Fed has 8 different meetings. They're generally 6 to 7 weeks apart. Today is the first meeting of the year. Right now, markets believe that the Fed will leave their Fed funds rate unchanged. It's about a 95% expectation. So we expect that when the Fed releases their policy statement, they say, okay, we are making no changes. We're not raising the rate. We're not lowering the rate. However, what markets are looking for is they're speculating what are the chances the Fed will make an action at the next meeting or future meetings this year. Right now, we are seeing that Fed futures are moving from yesterday to today much more in favor of an expected Fed rate cut to happen in March. As of yesterday, most of the market believed that we would see a Fed rate cut by May. So this chart here shows that right now the Fed funds rate is at 5.25, 5.25. And by May, markets believe it'll be either at 5 or 4.75, that the Fed will either have done a quarter point rate cut. They always cut in at least 25% increments, quarter point. So they'll have either done one, or maybe they'll cut at a half a point, or they'll have cut in March and they'll cut again in May. So a lot of these fancy charts, what we're looking at today is there's an opportunity in this afternoon. There's going to be a lot of movement in mortgage rates. So mortgage rates that you were quoted yesterday or Monday, they're going to be different today and tomorrow. You're going to want to refresh those rate quotes and talk to the mortgage people again and find out same scenario, what are those interest rates today? Now, depending on how things go at this meeting today, and more importantly, how things go at the press conference following the meeting, when Fed Chair Jerome Powell at 2:30 p.m., he holds a press conference, and all the different journalists are in there, and they're going to ask basically the same 4 questions in different ways, trying to trip them up and find out, what is the Fed going to do? It's basically, I'm a big poker guy, so I always have a deck of cards handy. I know it's kind of creepy. All right. But they want to know, what is the Fed's hand? They want them to kind of show some cards and tip that hand a little bit and show them what is it that the Fed plans on doing. Now, if markets believe that the Fed is going to have to cut their Fed funds rate and kind of soften things up a little bit heading into March, well, we're going to see mortgage rates improve over the next couple of days. All right. However, if markets feel like the Fed is taking a more what we call hawkish stance, and there's 2 birds. I don't know who came up with the bird thing, but dovish means more accommodative, lowering rates, helping the economy. And hawkish is the opposite. That's generally raising rates, trying to slow the economy down. And that's where the Fed has been for 2 years because of inflation. They need to slow the economy down in order to get inflation back in check. It looks, we're seeing a lot of signs over the last couple of inflation reports that that's happening. And now markets believe the Fed will want to go ahead and start to cut that Fed funds rate, because if they leave it where it's at, it's basically like if you put your foot on the brake. You've slowed the car down, but if you keep your foot on the brake, well, you're going to bring the car to a stop. And the Fed does not want the economy to stop. They don't want the labor market to collapse. They don't want unemployment to go up, because their mandate, their job is two things. It's to keep the economy stable, which they feel is a inflation rate of about 2%. And they want to keep the employment maximized, which they want to keep unemployment where it is now. So because of that, today you're going to see a lot of movement this afternoon where we get that Fed meeting, where we get that Fed press conference, and we're going to see mortgage rates that are going to react. So if you've got a rate quote, if you're not locked in, you're going to want to refresh those. Nathan, any questions or anything you would add about what I just said?
No, I mean, you covered it. If you've gotten a pre-approval in the last few weeks, make sure, after the news today, get that updated, because one way or the other, the rate is going to change, right? Whether it's good or bad, it's going to go up or down. But it could affect your qualification, especially for those borrowers out there that are really tight on their debt to income, residual income ratios. So just stay in contact with your mortgage broker, and that open communication. Make sure they're communicating with your realtor, so you're not out looking at houses this weekend that you no longer qualify for.
Great advice on that one as well. And as far as a rate forecast goes, we expect mortgage rates to improve this year. They are higher than they've been historically and much higher than we've averaged over the last 10 years. However, they're not going to go down to pandemic levels. Don't get excited and think the bottom's going to fall out and rates are going to drop to 2%. That's not very likely. But rates that are currently in the 6s may go back into the 5s, and it could be even better than that. Maybe it could be the 4s, but we really don't know. And anyone who thinks that they know, well, I've been there many, many times, and I think that I know, and I get shown very quickly how those tea leaves can change, and my crystal ball is not all as cracked up that I thought it was. So, definitely you want to, buy with the intention that you can afford where you're at today. But if you can't refinance or you can't make changes, that you'll still be okay. So, but that's it. I try to keep these short. Nathan, anything that you want to add for everybody?
No, just if you have questions, you have concerns, just address them in the group. Please, share someone else in the group has the same concern that you have, right? They have the same question that you have. So please post those questions. That's what we're here for. We want to answer. We want to help. And without inundating you with a bunch of I can help you. No, we're going to give you the answers and the advice that you're looking for. And like I said, those questions that you want to ask, trust me, there's 100 other members that want to ask the same question. Please ask. You're not supposed to know this stuff. Yeah. I think that's the biggest thing people get tripped up on. So I got this question I want to ask, but I don't want to. It's like, you shouldn't know it. Trust me. The reason Chris started this group is because even within our industry, there is a lot of people who don't know the answers. So,
and that's one thing I want to emphasize too, is if you think that you've heard it other places and you want to confirm it or see if people feel a different way, this is a great place to ask. So my point being, I love YouTube as much as the next guy. I love my dopamine addiction that I can go on there and watch some poker hands. And I see a lot of real estate stuff, and I see a lot of people with clickbaity ads, and some of them are very sincere in their belief that we're in a housing bubble, that the housing market's going to crash, the prices are going to come down, the things are, and they'll say these things. And I hear consumers clamp onto that and go, yes, prices are too high. They got to come down. And the answer to all that is no, they don't. No, they don't. Believe us. We see this every day. We sit there scratching our head. And 10 years ago, when I was in this business, I said, how could prices possibly, go high, and then they continue to go high, and then they continue to go higher? Just like the stock market has recently hit new record levels. Well, we've heard that over and over and over again. It's always hitting record levels. It goes up. And that's what happens to home prices too. So if you have questions about anything that you're hearing and you want to confirm it or get somebody that doesn't have a dog in the fight and then get their opinion, that's what all the VETA moderators are here for, and specifically not allowed to solicit you. So you're in we'll call it a safe space. We'll get a little woke. We'll call it a safe space, and where you don't have to worry about people just trying to tell you what you want to hear. They're going to be telling you the truth. So that's it. Well, thanks, Nathan. Appreciate you joining on, especially with short notice. And it was good chatting with you, and I'll see you again next time. Take care, everybody.